Now, if you're a home buyer at 50 and you want to retire at 55, then you need to make sure that you've got enough resources available to make sure that you cover that mortgage payment. But my most successful retirees are the ones that have no debt.
Your relationship with money matters. I'm Michelle Perkins, and this is the Money and You podcast, where I will be breaking down your relationship with money, offering tough love money tips, and a money dating plan that will focus on lifting the barriers to success to help pave the way for better money practices and increased wealth. It's time to take control to live a limit-free life. It starts today. Hello, and welcome to another episode of the Money and You Show with Michelle Perkins. So happy that you're here, and even more happy that I actually have a guest in studio today. That is something that doesn't happen that often in the days of Zoom meetings, and so very, very excited to introduce you to a fabulous financial expert named Philip Board, and he is going to actually introduce himself today so that you don't have to listen to me read a bio. I'm going to have Philip jump in right now. Welcome, Philip.
Thank you for having me, Michelle.
Thank you. I'm super excited. We met a while ago. We were in a business coaching, mentoring group, and we had met, and we're having fun actually doing some videotaping that day, and we got to talking. I learned about Philip's profession and thought he would be a perfect guest for the Money and You Show. So I so appreciate you being here.
Thank you so much. So where did I start? I've been a financial advisor for 27 years. I'm losing track. It's been that many because once you hit over a quarter of a century, I think you should just stop counting. Where did I start? I actually started in financial services with a friend of my dad's. He approached my dad and said, "Hey, I know your son works for you, but he can sell. So if he can pass this test, I've got a job for him." And I was like, "Oh, yeah." And at the time, Wall Street, the first one, had come out, and those guys were driving really nice cars. And I thought, as a 20-something, I would love to have a really nice car. So I end up taking what is the Series 7 and pass the test. And I show up, and I'm like, "I passed." And they said, here's your desk. And it was a small cubicle with a phone and a phone book. And he said, pick up on the letter D's because the last guy finished on the letter C's. So that's where I started. Fast forward, I started my own company a couple of years after that. At the time, I guess I was on a cutting edge because I started in the front room of a house I was renting with 3 other guys.
Wow.
On a shoestring budget. And I mean, absolutely shoestring. And that's where I started. So fast forward now today, I'm a branch manager. My current role is president and CEO, chief compliance officer, and I oversee 12 other reps. I think as a branch, we're about $500 million.
Wow.
Wow. So it's grown tremendously. And I started with nothing and I have
Something.
no, more than nothing now.
Yeah.
So that's kind of my background.
That's a great story. Actually, it sounds like you were at a very early age, you went off on your own to build your own. What actually prompted that? Was it just an entrepreneurial spirit, or what was it?
Yes, entrepreneurial spirit. My parents owned their own company, and I worked for them during high school, after high school. I was running 22 employees for them when I was 19 years old.
Wow.
And I always had that around me. And you ever heard of a book, The E-Myth?
Of course.
Okay, so my mom hired Michael Gerber after he wrote the first book.
Wow.
And so I met him, and he came into the company, and the whole "don't name your business after yourself" kind of thing. Listen to that. And so I've always had this entrepreneurial spirit about me, and working for somebody else, I actually butted heads with the then branch manager.
Okay.
He wanted to put me in a box, and I'm not an in-the-box kind of guy. Yeah. I ended up being the entrepreneur in this case, and I'm also now a teaching rep within my broker-dealer. I teach other financial advisors, not how to be better financial advisors, but how to run better businesses.
Interesting.
systems, processes, things like that. So I've got this diverse background in, well, business ownership, financial planning, and how do you combine the two together to get where you want to go.
Yeah, I love that you bring that up because that is something that I feel like people don't necessarily know, which the E-Myth does a great job of helping people to understand this. But because you have an expertise in something, even finance, doesn't necessarily mean you can run a business well. And
True.
yeah, it's a misconception out there.
And you'd be surprised how many financial advisors, especially on the independent side, because they are all independent business owners, just don't know how to run a business effectively. So it's a unique talent. I would say 5% are really good at running the business and being a financial advisor.
Yeah.
The other 95 are trying really hard.
Yeah, I find it fascinating because, I have a lot of expertise in the area of dentistry and medical practices and things like that. And, of course, it's kind of obvious that doctors and dentists don't get any. No, I'm not, actually. Your teeth are lovely. But I'm still thinking about business. So, but they don't know how to run a business. But people they get that. But financial people, I think people would assume differently. So the E-Myth is, I'm glad you brought that up too, because a really excellent book for anyone starting a business or having started a business and, feeling like maybe it's not going exactly as they wanted.
Other in this coaching program, it's really quite common. So anyone out there that's, starting a business, running it, and you find yourself that you kind of are just punching on this ceiling and beating your head against the wall. And the reason you're going to end up being successful is because you just keep doing it. Just keep turning over new rocks. Don't give up. So yeah, starting a business it's really hard, but it pays off if you're consistent and you stay with it. Just like going back to money and savings and investing. It's the same thing. It's got to be consistent.
Yeah, well, that's a good segue. So let's move back to money. I am curious because this is where my mind goes. My mind really doesn't go to teeth, but my mind goes to money. And when you're talking about financial planners actually needing some help with running their businesses, I'm thinking the piece that's always left out is understanding your own relationship with money, which is a lot of what this show is about. And I think those financial people, while they have a lot of practical knowledge and skills and everything, don't necessarily understand that relationship piece or even their own relationship with money.
Possibly, but I'm not going to 100% agree with you on that. I would say a lot of them actually have a pretty good relationship with money. But there's a saying in my industry, and it's you can have two types of experience. You can have an advisor with 20 years of unique experience, meaning that they're growing each year, and you can have an advisor with the same 20 years of experience, meaning it's the same year over and over again.
That's very interesting.
And I would say that's not just within my industry. I think it's potentially anywhere. There's a reason people don't launch or grow, as the case may be. But I think a lot of financial advisors, they have a great knowledge when it comes to investing, but when it comes to running a business and guiding a business owner on their investments is slightly different.
Yeah.
I think.
Okay. Yeah, I usually am sort of curious about people's, their old money beliefs that show up in their business building, whether that's, you should never have debt or, and some people are like, yeah, debt's the only way, I'll be able to build my business. And so people are just coming at this from different belief systems.
I would say a lot of that happens around the kitchen table growing up, I think.
Yeah, exactly.
Is where money comes in. In my own life, I'm an older dad. So we adopted both of our girls. They're currently 12 and 14, almost 15 as of the time of this recording. And I'm in my I'm past my mid-50s at this point, which is frightening to say. I don't know when that happened. So the conversations we're having, like a lot of people have their kids young and they say, oh, we can't afford that. Our story is different. We went through that. We can't afford it when it was just my wife and I, when we were starting everything. So now the vernacular we use with our children is it's not in the budget to make them think about money. That being said, my youngest daughter a few years ago, she broke something. I'm like, well, that was silly. Why did you break that? She goes, well, don't worry. Amazon will send us a new one. And we're like, well, what do you mean? They go, well, it'll just show up. They'll send me a new one. And not realizing, I said, do you know that somebody has to pay Amazon to do that? And she said, no. Had no idea that somebody paid the bill behind the scenes. They don't see. I think this is a statement of our cashless society.
Yeah.
Kids don't see money changing hands. We order on Amazon, it just shows up. No money was changed hands because mom or dad paid the bill online.
Yeah.
Right?
Yeah.
Even ordering food, it just shows up because we're in this almost cashless society. So I don't think kids really understand what that is. And back to trying to keep on track because I'm a little bit of a squirrel. I'll meander.
You're fine. This is interesting.
So my older daughter, I set her up with am I allowed to say a brand name of something on here? Okay, it was a Capital One money account. It's a kid's money account. And I just have been transferring money into it. And then once she turned, I think it was 13, she got a debit card with her money. And recently she was hitting me up for something. She's like, Dad, I really want this. And I'm like, well, it's not Christmas. It's not your birthday. And being an adoptive family, we celebrate Gotcha Day, which is the day we met them. So I'm like, it's not one of those three things. So explain to me, well, because Dad, I really want it. And I said, well, if you want it bad enough, you'll use your money. And she kept at me for about 2 weeks. And after about 2.5 weeks, she's like, okay, how do I pay for it on Amazon with my money? And once she acquiesced to that, then I bought it for her because I'm a girl dad and, they own me. So, but I wanted her to be willing to spend her money first because that would tell me that it was important enough to her for her to dig into her wallet.
I love that. And I think people listening are going to love this too, because we do get a lot of questions about how can I help my kids understand money? And your point about it being a cashless world, and so creating sort of a magical thinking among our kids is a really good point. And what you were talking about is a very simple thing that you can do with your children. I did the same. I took them to Bank of America. We sat down. We let the person explain how banking works, and then I got them a debit card. And most of the time, I would pay for things too. But at least they had to look at an account and see debits and credits going through, and understand a fee, and some of the real basics. And I think that's a really great step to take.
Agreed. That being said, I'm not going to do that for my younger daughter yet because she's the one that would drain that account online within days.
But then she'll get fees and she'll come and ask you, what is this?
Possibly, but they're different kids. My older one is mature beyond her age.
Yeah.
My younger one is still younger than perhaps her age. So we're going to give her a little bit more time before she has access to her money. That being said, she's come to me and she said, Daddy, I want to get something online or whatever. And she runs in her room and she'll hand me cash.
Yeah.
I'm like, okay.
Yeah. Nice.
Yeah. So
I love that. And I do think we have to kind of get creative. I mean, I remember my mom, I've said this on other shows, sitting me down with the check register, showing me how to write a check, telling me how it works, making me put it in the register. And those lessons, I mean, my memory isn't so great anymore, but those lessons I remember like so clearly. So any money, and you're in the finance world, so it's probably easy for you to talk to your children about money. I think a lot of parents have problems with that. Either they don't feel they know enough themselves, or to lead their kids in the right direction, or they don't know kind of like what's okay to talk about or not okay to. We have a weird thing about talking about money.
Absolutely true. So my wife, when I met her, she was a working at a bank.
Okay.
So she was in finance as well. And being a financial advisor, I'm talking to people about their personal finance. And one of the questions that I need to ask in order to know my client, which is a rule, is how much money do you make? And she goes, I can't believe you would just ask somebody? You do not ask people how much money they make. I'm like, well, I kind of have to. But in her world, growing up in her family, you just did not talk about money. So for me to come at it like, well, I need to know, who am I talking to? What resources, what's their ability to save for their retirement or nest egg or a future business or a house or a car, whatever it is, I need to know.
Yeah.
Because if they're on welfare and they want to buy themselves a Lamborghini, we've got a problem. That is not going to happen, right?
Right.
Let's combine to get to something that you can afford. And how about getting a better job first and moving on?
Yeah. I'm going to stop you there and compliment you because I love your sense of humor around this. And I think for people who are, reluctant to go to a financial advisor because it's such a serious thing and we're going to sit and have this, hard heart-to-heart about money, I think what you're showing people is, you can be their ally and you can have fun while you're doing it. I think a big problem with money is money's never fun. Money's always, kind of fear-inducing.
Thank you for that. One of my rules is I've got to enjoy who I work with. Unfortunately, I'm at a stage in my career where I can make that choice, and a sense of humor is key. People ask me, well, how much do you charge? And I go, a lot, and I say that tongue in cheek. It is something that you need to talk about is how do we get paid? And
there's a lot of mystery around that.
A lot of mystery
around
that.
People out there saying, ooh, financial planners are going to, you've got to worry about that. So you're saying just ask. Just ask.
So the reason there's so much worry about financial advisors is we're governed by two bodies, the SEC, Securities and Exchange Commission, and FINRA. And they basically allow us to have a negative rating, but up until recently, we weren't allowed to have positive ratings.
Wow.
It's an endorsement. So the reason if you do some Googling and you only find bad reviews around people like myself is because that's all we were allowed, which is crazy. If you're allowed a negative, you should be allowed a positive. But I think they made a change to that rule in the last year or so. So hopefully that's coming around.
That's very interesting.
But isn't that interesting?
Yeah.
So that now perpetuates the stigma of bad people. We're just here to take advantage of you. Unfortunately, the rules that are made in our industry are made for the Bernie Madoffs, if you remember who he was, of the world. And the reality is the other 99% are really great people and they want to help you.
Yeah.
And you just got to find someone that's your vibe. If you don't like to have a sense of humor around money, not saying we're going to be flippant about it, but then maybe I'm not the right guy for you, but there is somebody out there for you. So I enjoy working with a sense of humor. If I may,
yes.
When we originally met, one of the things that I brought up is the different, I think this coincides with your mindset.
Yeah.
And I think there's 4 levels of that. And I'm sure there's plenty of books on behavioral finance out there. But from my experience is that the first one is survival, right? So you get out of school, maybe you don't end up with the perfect job you want and you are literally in survival mode, right? Or maybe you didn't go to school and you just need to try and keep the roof over your head. And if you're lucky, eat something more than top ramen once or twice a day, right? And that's survival. And so that has this negative connotation because the bill collectors are knocking on your door and you just don't feel like you can get ahead and so it leads to this, I don't want to call it depression, but this oppression towards you about money. And hopefully you're able to work your way through that and get to the second stage, which actually is now a spender. And I classify a spender as somebody who's survived survival mode, and then they've leveled up now and they have money and they can now buy themselves an iPhone, and maybe they bought themselves a car, and maybe they got themselves the outfit that they've been looking for, and they have that. So they're having this sense of havingness.
Right.
And some people stop there. Some people never get out of survival.
Would you like to just comment on why you think that is?
I give up. I think they give up. They just get beat up, and maybe you don't have the right people around you. If you're the wealthiest person in the room, you're in the wrong room. If you're the smartest person about money in the room, you're in the wrong room. Level up your friends. Hang out with people that have a little bit more than you, and you work your way up. That doesn't mean to say if you're fresh out of college, go see if you can latch yourself to Elon Musk, a billionaire. You've got nothing in common. I mean, don't be wrong. I'm a fan myself. I love the way he builds companies. But find somebody who's already been through what you're going through, and heck, ask him for advice. Ask him for help. People love to help people, and if they won't help you, then they're not the right people.
Yeah, that's great advice. And just to piggyback on that, we do have some of our own glass ceilings. So I think when you suddenly do buy the car and the outfit and everything, you might just think, wow, I've made it. But you might not yet be able to think beyond that. So when you feel like you're there, I think that's when you start asking the questions of,
now what?
Yeah, exactly.
Right. So great question. So from there, the next phase of that is you move up from spender, and hopefully you move into saver. So a saver, when I'm talking about people that come to me and they have money, they've saved money, I can classify them quite simply. You can argue that the market goes down once in every 5 years.
Okay.
Right? My savers are more worried about the 1 in 5 than they are the other 4. They're more worried about losing money. And I think it's part of that. I don't want to go back to being the in survival or in... they just don't want to go back to survival. Let's skip spender.
Yeah.
The chances are maybe they went straight from survival to saver. And they skipped spender. A lot of people do, right? So those people are more worried about not losing money. But then there's the fourth, what I call a grower, which is what I am. And I would say anyone that owns their own business, you're a grower. Business isn't always going to be good, and it's probably going to be bad 1 in 5 years. Mm-hmm. But how do you capitalize on the other 4? What do I have to do to make sure that I make enough money in these 4 that this one, we get over it? So that's what I would classify as the 4 types of money mindsets.
Thank you. Yeah. I do remember us talking about this, and I was hoping that you would bring it up because I think of it, it definitely those, I think of them as phases, and within each phase, there's a set of mindsets that I think people in that phase tend to have.
Correct.
The survival one is really interesting because especially if you came from that originally, you bring a lot with you, a lot of fear with you. And people are afraid of investing as well because you could lose. And I love what you're saying about the, out of the 5 things, it's the one negative time that you're going to focus on, which is such human nature to focus on that one negative comment that you get on your Yelp, and you've got, 100 great ones, and then suddenly they disappear, and there's just that one that matters to you. It's kind of the same, and I think we have to be very consciously aware that that's where we go, and to try to, to look at the positive, and focus on what we want and not what we don't want. So, how do you convince people, though, in your world, to shift their focus that way, so they can invest and feel good about it, even during, when there's a downturn?
So let's go back to somebody who's graduating from survivor to spender.
Yeah.
Right.
Okay.
So that way we're building up.
Okay.
I would say once you're in spender phase, start saving. I know that the day I got my license, the first account I opened was this guy's. Mm-hmm. I wanted to experience it, and I put $100 a month away, and it just into a mutual fund. And you could go online and pick one and just, look one that's got a decent return and just keep putting your $100 a month in. And some time will go by, and the next thing you know, you've got a chunk of change, and maybe it's the down payment on your car because your car broke, or maybe it's a down payment on your house. Who knows? But that's the first thing I would recommend you do. And I don't like to see people open a savings account attached to their checking account.
Yeah.
Because all that is an extra fee scenario, and you're not making money. I like it further away. By all means, link it to your checking account. But if you've got to make a decision that you've got to liquidate your investment to buy the thing that you're thinking you want right then and there, it's a little harder to do. So once removed, rather than, it's inside my bank. If I spend too much on my checking account, they automatically pull it in for me at no cost.
Yeah.
No, that's not long-term savings. It's just an extension of your checking account. So I would start there, because now you're getting into this habit of, and at first it feels like you put $100 a month away and you're like, well, that's $1,200 in a year. Yay. Mm-hmm. But you do that for a few years. Next thing you know, it's grown some, and maybe it's $5,000 or $10,000, or maybe you increase it. Mm-hmm. And now you notice that it starts to move when the market goes the right direction, which it does more often than not. And so that's phasing into that, from that spender to that saver mode.
I love all of that. I wanted just to ask you, because I do think some financial experts out there would have you go from survival to saver to spender. Like, that's your reward for saving. I personally feel I don't necessarily agree with that, but I think you can do a little of both, which I think is what you're describing.
It is. And the reason I put them in that order is I've been doing this for 25 plus years, and I have noticed that there is, when you go from this phase in your life of not having to now being able to afford to breathe a little bit, the last thing you want to do is put yourself back in the position that you were
right
for 100% savings. And that goes with debt as well. And everyone's got their own theory on debt.
Yeah.
I mean, there's apps that you can use to pay off debt. And if you overspent and now you're in debt, then you kind of got to deal with it. My argument would be, don't get to the point where you're in debt over your spending in the first place. But if you can save a little bit while paying down your debt, because this is what I feel. I do not have a psychiatry degree. Put that out there. Not a psychiatrist, but in witnessing what has happened is, if all you're doing is all of your extra money is going to pay down debt, and then the transmission goes out in your car.
Yeah.
And it's $2,000.
Yeah.
And you have no cash. And guess what you're going to do? You're going to reach in your pocket and you're going to pull out the credit card you just spent months paying off.
Right.
Right? Because you have no savings. So by putting money in savings each month, maybe a little investment account, something small, plenty of places online you can go. I got to admit, not my average client is looking to put $100 a month away. But there's plenty of places where you can do that, and very reasonably, free, I think.
Yeah.
So by doing that, the transmission goes out, and maybe you've got $1,800 in cash you can get your hands on, and then you're only hitting $200 on the credit card, which isn't as bad, right? And I think that's a psychological.
So much of this is emotional and psychological, and I agree with you. And I think that feeling of, I didn't go right back to maxing out my card. Like, because you do that too many times, you start to feel like it's always going to be that way.
Defeat.
And it's very costly every time you're maxing out your card and paying it slowly. And I think, when it comes to things like the little more spiritual side of money, or a little law of attraction stuff here, you need to start developing, especially if you've been in this survival mode. Money doesn't feel so good. It feels like a threat all the time.
Mm-hmm.
And you start being able to buy yourself some things, or feel like money, is a positive sometimes. It starts that feel-good vibration, I think, is very important to build momentum.
I agree.
With money.
It is.
Thank you.
It is. I'll agree with you entirely. So we were just talking about debt. One of the thoughts I have is when I see people retire, and the ones that have retired most successfully retire without debt. Mm-hmm. Now, the only exception to that would be is if you got a mortgage and you're paying under 2% for it, never pay that thing off early.
Yeah.
Chances are you're out earning that by a lot with your investments. But if you're a home buyer now and you're getting into a higher interest rate environment, work hard to pay that down and off by retirement. Avoid home equity lines, avoid refinancing to pay off high interest debt. Don't get the debt in the first place. But if you have to, I guess that's one thing.
Now, are you saying this because the interest rates are high? If they were low, like they were a few years ago, would you still be saying this?
I would still be saying it if they're low, but it still comes down to what other resources do they have available.
Okay.
Right. And if you're 30 now and you will retire at 55 or 60 and you've just bought your house, it's not that hard to just make an extra $50 or $100 and you'll pay it off in 25 years. So it's going to happen naturally.
Right.
If you're a home buyer at 50 and you want to retire at 55, then you need to make sure that you've got enough resources available to make sure that you cover that mortgage payment. But my most successful retirees are the ones that have no debt.
But what are some keys? Because that was a great key. Don't retire with debt.
Yeah. Don't be so afraid to invest because of that one down here. Yeah. Try and get some of your money in that grower mindset and don't be so worried about losing money. That being said, don't be silly. Don't put it all in crypto and roll the dice. I mean,
I know that
we don't.
People who've done that.
Yeah, we're not even. I'm not allowed to sell crypto since it's not regulated by the SEC. Mm-hmm. So, don't be foolish with your money, but you need to put some of it in a bucket that is a grower mindset longer term, even as you're approaching retirement. Be good at budgeting. Quite often what we see is, I'll just work some extra overtime while they're working. Once you retire, there is no extra overtime. What you get is what you get. I see people outspending during retirement.
You do see that.
I do see that.
I know that is a fear. I know my father-in-law was petrified of that every day, and he was fine. But they were living much longer than I think than expected.
Yeah.
And,
make sure you have a relationship with an advisor that's got some long-term planning, just not the next 2 or 3 years. I know the area that I spend a lot of time is in taxation. Mm-hmm. And this is something new that I'm I don't want to say I'm struggling with, but we were told as a financial services company, always put money in IRAs, tax defer, but money in your 401k because you'll be in a lower tax bracket when you retire. No, I don't know anyone that says I would really like to live on a lot less money in retirement. No, I'm not seeing it at all. What I'm seeing is I want to maintain my standard of living in retirement, which means, well, where's the money coming from, right? So, a lot more emphasis on Roth IRAs if you're younger, because those are available to you tax-free. Nobody will ever pay taxes on them, at least under current legislation.
And what's the maximum you can put into those in a year?
In your 401k, they keep moving the number. Yeah. If you're over 55, I want to say it, or over 50, I want to say it's almost $30,000 this year. Inside your 401k. If you're under, it's a bit less. And
okay.
If you're doing a regular IRA, $6,500 or something like that. But if you've got a retirement plan already, then do that first. Mm-hmm. So when I'm looking at taxable buckets, though, right? So putting more in the after-tax bucket, which goes back to this savings thing that we talked about. Okay, you open up a mutual fund or it's a brokerage account. So for our clients that have after-tax money, meaning they've already paid taxes on it, and it's in a brokerage account, we're looking at how do we reduce taxes on that money?
Yeah.
I've got doctors with huge multi-million dollar IRAs that they're now 73. They're having to take out required minimum distributions of $200,000 they don't want.
Yeah.
Which now they're paying income tax on additional $200,000 in income. It's pushing up their Medicare premiums, which is something nobody talked about.
Right.
So there's this bigger tax issue later down the road, and most people aren't even talking about it. So I think if you've already put money in your 401k, great, keep doing it. I'm not saying don't, but also save money on the other side of the tax line. Because I see people that they're 401k rich,
yeah,
and cash poor,
yeah,
and then they use their 401k as a revolving. Oh, I just took a loan out, and they took $50,000 out and they spent it on something. Now they spend the next 4 years paying it back, and as soon as it's paid back, they do it again.
Yeah. And I don't even know. Are you taxed on that when you take it out for that purpose, or is it still
while you still work for them? It is a non-taxable event because it is a loan.
Okay.
However, if you leave that employer and that loan is outstanding, it's a taxable event. And if you're under the age of 59 and a half, there's a 10% early withdrawal penalty.
Interesting.
So if you took a loan and then switched employers, you get a $50,000 outstanding loan, you owe all the taxes on that. So about $10,000 plus another 10%. So now it's $15,000 in tax, and
yeah,
congratulations, figure out how to pay it. So I try and avoid. In fact, for our own 401k, I think it's written in our document, but I do not publish that they can do it because I don't want them to. I think it's bad planning.
Yeah. We did borrow against 401k for a business that we were starting, and it was a small amount. And in my mind, it was like, oh, but I'm paying myself back with interest, so it's all really
great.
You are. But I didn't understand. I'm so glad you brought this up, and I think people have to have this conversation with their advisors who may or may not have that much information to provide. But the tax piece of it, until I was taking care of my parents and seeing how much they were paying at 89 and 94, and in my mind, I'm like, they've been retired for a long time, they're on Social Security, they're not going to pay any taxes. And then I'm working with their tax accountant, and I was stunned, and I didn't know about minimum required distributions, and it was a big eye opener and kind of sad. Like they were paying a lot.
Our senior citizens are retirees, and I'm going to call them late life retarees.
Mm-hmm.
That when they're so, let's say, of course, if you're 73, you're like, I am not late life, because apparently I can get a senior discount now, which I'm not thrilled about. So, no, I don't want it. It's good. I'll keep paying full price.
I did that.
I'm in total denial. So our later life retirees are the ones that are paying massive amounts of tax. Now, that being said, there are ways to lower those taxes.
Okay.
If you have money outside of your 401ks and your IRAs. And that's an area where I spend time.
I'm so glad you brought this up, because I really have been questioning for myself, all these years, same message, just always put into your 401k, your IRAs, whatever first. And when I saw my parents, I started thinking something's amiss here. And, but I didn't know an alternative really. So anyway, I think that this is a very worthwhile conversation, something for people to think about. What would be an alternative?
So, like, for instance, when you look at, if you think about taxation as a quadrant, right?
Mm-hmm.
So you've got, usually in one bucket, it's things like your cash, your savings account, brokerage account is taxable. Maybe you've got some real estate, which is your house. Now that's pretty tax efficient, right? If you've got investment real estate, that's also can help you out. From a tax perspective, if you've got a corporation that you can use to offset depreciation and things like that. So that's tax efficiency. Most people have the IRA bucket, which is 100% taxable, but the bucket that they have the least amount of money in is tax-free. And, obviously Roth IRAs fall into that. If you're closer to retirement, putting money in a Roth, you've got to leave it there for 5 years before you can get it out. So that kind of is a bit of a headwind. I know there's different types of insurance out there. So universal life, not all universal life policies are created equal. Some of them have some very, very high expenses in them.
Yeah.
I do not like those.
Yeah.
We have access to a couple that are incredibly cheap. And the thing about universal life is most people sell it incorrectly. I can afford to save $400 a month. What's the most amount of life insurance I can get? You don't want that. You want what's the minimum amount of life insurance?
Oh.
Because life insurance is expensive.
Right.
So we sell ours with maximum payment, minimum death benefit, because we're not buying it for the life insurance. We're buying it for the tax code. It's 7702 if you want to look it up. And what it allows you to do is put large amounts of money into this. Now, there's no tax deduction for it going in.
Okay.
But when you take it out, are the ones that we have, if you own it more than 10 years, there's a zero interest rate on borrowing the money out. So now you've got this tax-free bucket. So now what do you do with that, right?
Right.
You've got this bucket of money that has no taxes. First of all, if you take $50,000 out, it's not going to affect your RMDs, your Medicare premiums, or any other income tax that you have. So that's good.
Yeah.
But maybe you could use it to pay the tax on the RMD. So now you can maybe accelerate your required minimum distributions and pay the taxes now rather than later. So you've got that window of Medicare premiums. You've got to apply for Medicare at 65.
Right.
Yes, you're going to have income that's going to affect them. And it's for 2 years. They look back 2 years on your Medicare premium. So if you're depending on when you're retiring, there's a little bit of thought that needs to go in saying, okay, when and how do we draw that money out to get, in a perfect world, you want to be in a place where you pay almost no tax the later you are in retirement.
Yeah. Yeah.
So
that's kind of what I thought it would be, but then it wasn't.
No.
Yeah. So that kind of strategy, and this is where people try to save money by doing things like taxes themselves, but you have no ability to strategize in the way a person who's knowledgeable about taxes would, or a financial advisor who understands how everything works together. And so I really think that's where you need the help and the support.
I would 100% agree. I actually was sitting down with a couple of CPAs last week, and not all CPAs are created equal.
Right.
Some of them are literally tax preparers, which is you show up with your documentation, they put it in a spreadsheet, and you either owe or are getting back this. And oh, by the way, you should have done this last year.
Yeah.
That's what a lot of people do. That's your I go visit H&R Block, and that's probably appropriate for a lot of people that just have straight up W-2 income.
Mm-hmm.
If you're starting a business, I would definitely get a relationship with a CPA because they know, and you want one that is more about, in fact, the one I met with last week, he said, we completely changed our practice. It used to be that I'd sit with them, I'd gather the data and go, great, and I'd send them you either owe or you're going to receive.
Yeah.
Right? That's it. He goes, we changed it entirely. Now, somebody else in the office meets with the client, gathers all the data, it goes into the tax prep software that they use, and then the CPA meets with the taxpayer to say, okay, what else can we do? Do you own a business? Did you have these other deductions? And if you've got the right combination of investments, like if you're an S corp and you have rental property, you get depreciation from the rental property that offsets the income that comes over the top of the S corp. So you can become really tax efficient, but I don't know who's got the amount of time to really, you could probably chat GPT it, but it's not going to ask you the questions that need to be asked about your personal life.
Right.
Your business and personal life. And I would highly recommend getting to know a good CPA, and one that wants to meet with you in November and around tax time, that's tax planning. Right.
Yeah. And I would say this came up on another show where somebody was talking about a family office. And I would say that tax person needs to also somehow the financial advisor people and the tax people, everybody needs to get together and
Correct.
share the information, because then that's where you'll get the best strategy.
And that's exactly what we do. When we're sitting down with our clients, we're looking at, I want to see your tax return. If I come up with a solution that, I could argue that I know is viable, I'm going to tell the client, I think it's viable. Let's meet with your CPA.
Yeah.
And then we're going to get a blessing on the CPA. And it's a lot of what has taught me to become a better advisor. You sit in enough meetings with CPAs and taxation. And if your advisor isn't talking to you about taxes and your financial plan for retirement, you should ask, maybe they could, or maybe you need a different one. I don't. But yeah, taxes are key. It's not what you make, it's what you keep.
Yeah.
I mean, if you make $1 million and pay $750,000 in tax, why make the $1 million? But if you can make $500,000 and you keep $450 of it, that's a better deal.
Yeah. Yeah, that was my grandfather's advice, my immigrant grandpa, who always said it's not what you make, it's what you keep, which was passed down to my dad, passed down to me. I'm not sure I paid as much attention as I should have. But I love that, because it circles right back to the business owner who thinks they're doing really well, but keeping nothing and paying themselves nothing. So, yeah, beautiful. I hate that we have to stop, but I'm going to run out of time, and I want you to tell people about your podcast, about your practice, and how they can get in touch with you.
Well, thank you, Michelle. One-on-one Financial, that is the number one, ON, the number one financial.com is our website. Our phone number is 909-981-1720. We have several advisors in the office, and no matter where you are in your life, we've got somebody that can help you. And if not, we've got some resources for you as well. I have recently launched a podcast. It's called Financial Fitness. We've recorded 5 episodes as of this filming, but none of them are live yet, but they will be soon. So I'll share that link with you when it comes available. We do have some webinars on demand, and we'll be doing some webinars about the tax quadrant. And that's if you want to remember one thing, disinherit the IRS. We like that, because we like to think we spend the money better than they do. So on that note, thank you so much for coming.
Thank you so much.
For inviting me, I should say.
Yeah, no, I loved having you. We could have talked a lot longer. So I hope people will get in touch. And I love that you have webinars on demand. The more you learn, the better your financial journey is going to be. So, yeah, and I really, everything you brought up today was so valuable. So thank you so much.
And thank you for having me. Fantastic talking to you.
Yeah, you too. Yay. Well, thank you, audience, for being here as well. We love it when you listen to the Money and You Show. And you can find us, as you know, on all the podcast platforms, on Roku, on the Limit Free Life YouTube channel. Send us a question or a topic you'd like to hear more about at team@limitfreelife.com. And yeah, thanks for tuning in, and we'll see you next week.
Thank you. That was fun.
We good?